Hey, Freedom Fighters. Rob Berger here, author of Retire Before Mom and Dad. Today, I want to talk to you about something you may have heard in the news, an extremely sad story of a Robinhood customer who, believing that he had a negative balance in his account of over $700,000, committed suicide. His name was Alexander Kearns. I first read about it on the Forbes website, and it has sparked a lot of discussion in the media, in blogs, on Twitter, and I want to address it today in this video. Now, one thing I want to make clear is we don't know all of the facts. There is a screenshot that I'll show you of the young man's account. It shows negative, what Robinhood calls buying power of over $730,000. What we don't know, at least what I have not been able to find out, is exactly what caused that. There are times when your brokerage account can show a balance other than your actual balance. That seems kind of like impossible, right? But it can be negative. It can actually show a higher balance than you actually have. I've experienced that from time to time. Part of the reason is when you trade, it can take a couple of days for the trades to settle. And so your account might not reflect your actual balance until all of the different trades have settled. It's particularly true if you're trading options as well. It can get immensely complicated. And so there are times when your balance might not look right. Is that the case here? I don't know. But I want to use this opportunity to talk about what I call 4 rules of investing in light of what's happened in this situation. I think it's an opportunity to learn. And frankly, it's an opportunity to look at who you do business with and the brokers that you use. I don't use Robinhood. I don't have anything positive or negative to say about it. I've never used it. I do use M1 Finance, although for a very limited purpose. That's where we invest all of our credit card cashback rewards. And our balance now is about $10,000 or $11,000 invested in 3 bank stocks. No options, no margin trading. We're going to talk about that. But I use M1 Finance for that purpose only. I've never used Robinhood, but I do think this is an opportunity to think about where we're investing our money and how we're doing it. So I want to talk to you about 4 rules. Rule number 1, don't ever, under any circumstances, invest on margin. Do not trade on margin. What is margin? It's effectively borrowing from your broker to buy more stocks. And here's the thing. Margin makes money for brokers. They're in a business. They're trying to make money, and particularly those that allow you to trade for free. They have to survive, and I get that. And so they have to come up with a way to do that. One of the ways is to promote and offer investors to borrow money on margin, right? And the way it often works is you can borrow some percentage of the value of your securities in your account. I think at M1 Finance, I think you have to have at least $10,000 in your account, and you can borrow up to 35% of that. Those rules they're regulated, but they can also vary to some extent from broker to broker. But here's the problem with buying on margin. While it can, in theory, increase your returns, it can very significantly increase your losses. We should never invest on borrowed money. Now, some of you may say, Rob, I think I've heard you say that you should start investing even before you pay off your mortgage or your student loans, for example. I mean, isn't that the same thing? No, they couldn't be more different. Imagine this. Imagine if you're investing in your 401k and you still have student loans, and because of a bad market, your 401k drops by 30%. Imagine getting a call from your student loan provider and saying, hey, I saw that your 401k balance dropped by 30%, so I'm going to need you to pay off 30% of your student loans. You might think, wait a minute, Dad, is that you? Is this a prank call? What? Well, of course, that doesn't happen with student loans or a mortgage, but it absolutely does happen with margin trading. It's called a margin call. If the value of your stocks and other securities fall by a certain amount, they can force you to add money to your account to bring it back to the equity position that's required under the terms of the margin account. And get this, if you don't do it, they can sell securities in your account without your prior approval. Trust me, margin trading should have no place at all in your investment strategy. That's rule number 1. Don't trade on margin. Rule number 2, don't buy and sell options. I know options look sexy. They look sophisticated. Isn't that how all the savvy investors are investing? No, They're not. Buying and selling options, particularly for regular folk like you and me, is not a recipe for a sound investing strategy. First of all, trust me, you probably don't fully understand the options you're buying and selling. You certainly can't value them. Now, I know there are formulas that in theory can value an option, but they don't value them in the way that you think. And let me give you a quick example. A simple option would be a call option. I own Apple shares. I could sell a call option on my Apple shares. What's that mean? It means I am giving someone the option, but not the obligation. They don't have to, but they can if they want to, buy my Apple stock. Options contracts usually cover 100 shares. So let's assume 100 shares of Apple stock at an agreed upon price. They call that the stock price. And I'll give them that option for a certain period of time. So let's imagine Apple stock is trading at 300 bucks and I sell them an option to buy it from me for 320. And I say, you can do it, exercise the option anytime between now and say 3 months from now. Right? Well, that's a call option, and it's considered a covered call because I actually own 100 shares of Apple, so that if they're called away, if the buyer of this option decides, yeah, I think I'll take your shares, Rob, thank you very much, I have them to sell to them. And I can sell it to them at $320. Now, in return for selling that option, I'm going to get a little fee, a couple of bucks per share typically. Now, that sounds like not a bad deal. I get to keep that option price regardless of what happens. And what's the worst that can happen? He could buy my Apple stock away from me at 320 bucks, but it's trading at $300 a share now, so I'll make money. There's no way for me to lose, except that what happens if the stock spikes to $340? I've actually lost money, not in the sense that my account balance has gone down, but I've sold shares for 320 that are now worth 340. I'm pretty sure that's not a good deal. And here's the real point. You and I have no idea where Apple stock is going to trade tomorrow, let alone over the next 3 months. Yes, I know there are folks that think they know the answer to that, but they don't. Now, before we go to rule number 3, don't ever combine rules 1 and 2 and break them both. Trading options on margin. That's like you might as well just pour gasoline over your wealth and your portfolio and set it on fire. So rule number 1, don't trade margin. Rule number 2, don't buy and sell options. Before we get to rule number 3, one important point. A lot of brokers make trading on margin or buying options look sophisticated. I've seen one that describes margin trading as what savvy investors do. No, that's not what savvy investors do. That's what folks do who end up with less money than they started with. Okay, rule number 3 is really going to anger a lot of you, I'm sure, and feel free to leave comments. I'd appreciate it if you'd be kind in the video below. But rule number 3 is this: don't buy and sell crypto. Crypto is not an investment. Trust me, you do not know the intrinsic value of a cryptocurrency. Warren Buffett doesn't know the intrinsic value of a cryptocurrency, and I suspect he would tell you that. Actually, he may say they don't have any intrinsic value. If we asked Warren Buffett what the value of Bitcoin will be tomorrow, I am sure his answer will be he has no earthly idea. And trust me, neither do you, and neither do I. So, rule number 3 is don't look at crypto as an investment. It's not. Now, I know a lot of you are going to say, Rob, I know people have made a fortune in crypto. Maybe some of you will say you've made a fortune. Well, guess what? I know a lot of people that have made a fortune in the lottery. Seriously, I know some big lottery winners. It's not an investment strategy. Whenever the price of something fluctuates a lot, somebody is going to be lucky enough to make money. That doesn't make it a sound investment strategy. So don't trade on margin. Don't trade options. Don't trade crypto. Now, I'd like to leave this video on a positive note. So rule number 4 is a positive rule, something we should do, and it's this. Whatever you invest in it as if you cannot sell it for at least a decade. Invest in things you'd be comfortable putting your money into and then shutting the computer off, not looking at it for at least a decade. For most people, myself included, that's going to be low-cost index funds. Now, here's the final takeaway. There's a lot of influences out there that are going to cause you to look at things like margin trading, crypto, options as a way to get rich quick, as sort of a sexy way to invest, a savvy way, sophisticated way to invest. It's not. The odds of you having long-term success with any of those things are next to nil. And as we've unfortunately seen, they can cause pretty significant harm. Think long-term, invest in things you're willing to hold at least 10 years. And trust me, if you keep doing that, you're going to build a pile of wealth. Until next time, remember, the best thing money can buy is financial freedom.